All right. Hi and welcome, everybody. Thank you for joining us for our webinar today, UK Property Market Predictions, What's in Store for 2022. Today, our hosts will be William Page, Head of Middle East and Africa Wealth Management. Hi, Will.
Good morning, good afternoon, everybody.
And we will also have Jeremy Marshall with us, the Head of Abu Dhabi. Hi, Jeremy.
Hi, everyone.
Okay, so today we will be talking a little bit about what has happened to the UK property market since Brexit, as well as the impact COVID has had on rental and sales values. We'll be looking a little bit more into the cities and if London is still the #1 city for investment and what might drive property growth over the next 5 years. We will also be having a Q&A session throughout the webinar at the end. So throughout the webinar, please submit any of your questions and we will try to get to them at the end. Okay, over to you, Will.
Thank you, Nicola. So we want to get pretty briefly onto the subject for today's webinar, everybody. So just very quickly, there's sort of 3 key pillars really around our business model and how we operate at IP Global. So just a very quick overview. We're heavily research based on the back of what our research team deliver and what they provide to us as a company. We take decisions to go and actually co-invest, and we use a word underwrite developments. So that means that we've actually put our money down on projects and we've financially and legally committed to buying them ourselves, and we then have the right to sell those on to our clients. Benefits of that are obviously we put our money where our mouth is. That gives our clients a lot of confidence and our partners a lot of confidence. But also, it gives us access to interesting opportunities that ultimately we wouldn't be able to be involved in ultimately if we didn't underwrite. And then moving forward, when you purchase an investment property in somewhere where perhaps you're not living, you're not resident, you need a full service, mortgages, lawyers, management company. We own the bits of those that we can. So we own a management company that rent the apartments. We own a mortgage brokerage that finds the finance. We use trusted independent lawyers, obviously, in those markets. Where have we been and what we've done? We've been around the world. We've taken a trip around very different locations. We've been through booms where we've been investing in sort of higher risk locations. We've been through tougher times where we've kind of kept very close to sort of low risk locations. You can see it's over $3 billion worth of investment now in total. Where are we now? We're in the UK, we're in Germany, we're in Portugal. You may well see a new market from us next year, but ultimately we're focusing on, low risk markets where you can get leverage, where you can borrow money to maximize your returns and drive higher returns by getting growth on money that isn't yours. And ultimately markets we believe in and we know are going to be secure and robust.
So for the UK, as we're going to speak about today, and obviously the focus is going to be about 2022 and beyond, about where we think the success is going to be and where people can make money. But, UK has been our biggest market since about 2009 when we entered post-financial crisis. But I think it's important when we're looking at what's going to happen the next couple of years to really get a firm understanding of where we've come from probably in the last 5 years to where is the UK now, how it's recently been performing and how just before that it's been forming. So it's been a kind of one of a tougher 5 years, I suppose, particularly for London. But, we had, when Brexit was announced, that caused a lot of uncertainty in market, and uncertainty is probably the killer for sensible long-term investments. And so we had a lot of people kind of holding their hands, keeping their powder dry to see what was going to happen. And so there was partly a migration of investors, and particularly from foreign investors, to get maybe say outside the capital to go up north where there was potentially cheaper property and higher yields. But then we had, Brexit was finalized, announced, we had a majority government formed, and so that was all put to bed, and so that actually it helped the pound rebound slightly. It had a lot more certainty in market, and so there was a lot more people going to be buying. Then of course COVID came along, which was a huge question mark for everyone, and there was a lot of major consultancies and experts in the property world at the beginning of it kind of thinking, well, okay, I think the UK market might have maybe dropped by 7 to 10% over this time, but no one really knew. But that didn't happen. Actually, the market's been performing incredibly well, and over year on year we've seen about an just over 8% rise in property prices across the country. And this is, it's important to understand, I suppose, why this has happened. So what we really had was a bit of a storm of probably 4 to 5 years of people who were kind of, pent up demand. A lot of people, wanted to buy a property. UK still is the kind of arguably the safe haven status country to buy around the world. And so people were wanting to get in to buy, but also there's people who've been wanting to move and, get on with their lives, I suppose. So we had a big surge of property buyers. The government introduced a stamp duty incentive as well, which obviously helped bump market. But it means basically then that, we've had a lot more people purchasing in the recent past. But that's been helped with historically low interest rates. The Bank of England's kept that at 0.1%. So we're never going to find, interest rates as low as this another time. But also it's the chronic undersupply of property in the market. That's helping to push prices because there's simply not enough for the growing population. Depending on which board you listen to, there's anywhere between about 300 and 350,000 homes needed each year. And in the last 10 years, the maximum they've been able to get to is just under 200,000 homes in 1 year. So across the country, but particularly in the capital, there's a chronic undersupply of property across the board. Also, then you've got to remember that even though the pound recovered slightly when Brexit was finalised, that actually compared to long-term averages, the pound is still cheap against the dollar. So it still represents a little bit of an opportunity, particularly in line with the historically low interest rates. And then if we've got at the moment, as we see, there's a lot of projections for inflation to be able potentially hitting up to 5% in 2022. Property has always historically been a hedge against inflation. So that's probably going to increase, the large scale investors, institutional investors, so to mitigate their portfolios and put slightly more into property in that time. So what does that mean then? Does it mean we should pile in now? Should we wait? What does that mean in terms of, property and where the hotspots are and what's going to happen? And so I think it's relevant to talk about some of the questions that might come up with this. What has COVID done to shape our view of property world? Is there going to be a cultural shift? There's been a lot of talk about people moving outside the city centres, and is that true? And how, to what extent is it happening? I think my opinion here is that, as I said, we had a pent up, probably a whole generation of kind of middle class house movers who are maybe upscaling to their family dream home there. And I think there was probably a lot of that kind of moving outside the city centre there. And when they had the stamp duty incentive, it just encouraged probably 3 or 4 years worth of people to do it all in one time. So I think over the long term, talking kind of, 30 years or so, there will be an increased pressure for people to have a bit more lifestyle, move out of the city centres. But, particularly in any time where there's any kind of pressure on market and a macro economy, people congregate to where the jobs are, both on employers and employees in that time. You can't be kind of putting yourself out in the sticks where you really need to be finding employment. So cities aren't going anywhere, particularly big cities which have, so much wealth tied into them. So I think we'd be very confident basically in terms of the resurgence. And we've certainly seen that in terms of rental rates and prices within, areas of major cities which might have taken a bit of a hit over the COVID and the Brexit period, really, representing a bit of value. So we with this 8% rise in the last year, what do we do? I think it's just about following the same principles. Don't go chasing big discounts and think anything is going to be there, or distressed opportunities. That's not really existing, but it's just picking things for the right reasons are really good. So following the movement of people, knowing where the jobs are, and knowing what's the kind of money's being spent into market, so we can make the same sensible decisions we were pre-crisis and post-crisis, because that's the kind of property which is always going to be rentable and is always going to be have pressure on it basically for prices to rise in the long term.
Thanks, Jeremy. I love that picture of that little house sitting there all alone. It's very attractive.
COVID hideaway, yeah.
Exactly, yeah. But ultimately, we can't. We'll talk about that a bit later. But ultimately, we do believe in city centres, and there are reasons why. So what have we got here? I've lost my chain of thought. We've got the economic growth predictions for Europe for the next 5 years. And it's interesting to have a look really at the sort of powerhouse economies. You've got Germany obviously there as well, but I'll tell you just to take your time on that, because the blue is up to 2020, and then the orange is 2021, the gray is 2022, and so on and so forth. So really what you can see is that there's significant growth projected in, you know, many of Europe's economies, but particularly, you know, the UK has a strong growth path, Germany does, France does, and obviously Iceland's a little bit smaller, obviously, but also strong growth. So that, you know, these are the fundamentals that drive property values. You know, you need strong economies, you need diverse economies that are going to perform year on year for those people that live in those countries to be able to take their salaries and be able to invest in and buy into property. And ultimately that gives property that longevity of being able to hold its value. So we've then got another nice graph here, Oxford Economics, which shows us the GDP value and growth up to 2035. So again, Oxford Economics are very bullish on Germany and how much growth that's going to see. You can see up to 2035, you're looking at 59% growth in the GDP, but even more so, the UK leading the way with 81. So a small number, but a bigger percentage in terms of growth. So a very compelling figure. And then obviously you can just see how the other European countries really do sort of lag behind those two major powerhouses of Europe ultimately.
So, I mean, look, I think actually with that, I think a lot of what that shows is confidence in market. And I think it's an opportunity for potentially a post-Brexit era where there's been, you know, a potential softening of market, you know, having a 81% GDP growth to far outstrip anything else in Europe. That's probably representative of a little bit of elasticity to get back to kind of where it was. And so the confidence returning in the major internationals reinvesting. What we see here is the foreign direct investment coming into the UK, European markets over the last 4 or 5 years. Germany actually kind of took the mantle of the UK because of Brexit in that time. So it's had a huge amount of foreign direct investment, you know, just under $500 billion there, and the UK being second. Normally what we had seen before, and probably what the expectations are, is for the UK to come up to be in line with Germany now, is for those two to be the front runners, basically. You know, and so, you know, we are investing in Germany as well, but it's interesting to see the swing that's happened in the last 5 years. But the expectations going forward is UK and Germany to basically be neck and neck in terms of how much FDI is there. And actually, you know, just in terms of the property market, you know, London specifically actually is for the last year has topped all the city rankings across Europe with 16 billion in residential property up to date this year.
Look, I think to add, Jeremy, you know, those 3 slides really indicate why we and many of our, you know, many companies like us preach about the UK property market, and we particularly focus heavily on diversifying our offering into Germany. And there are 2 sort of key markets. You will see us enter other markets, but ultimately they will always be a core focus for us.
Quite. Everything has to be in line basically with the safety of the macro economy, and knowing there's, you know, enough people, enough good jobs, and enough pressure on the property market. And equally here, actually, probably for both Germany and UK, actually, it's a positive sign as well. We're talking about the unemployment trend or employment rate, and both UK and Germany being the lowest in Europe. Of course, everything has taken a bump and a rise over the COVID period, but, you know, with the kind of packages that were put together, the stimulus, the furlough plans and so forth, the worst of what potentially could have happened has been avoided, and most of these countries are projected to go back to pre-COVID levels within 2 or 3 years, but particularly UK and Germany back end of 2022 to be kind of, you know, the past unemployment rates, which is exactly what we want. You know, everyone has jobs, everyone has cash, and so, you know, it puts extra pressure on the rent.
Okay, so this is an interesting one because IP Global, we were all about London. I joined the business in 2013. I think Jeremy did as well, just shortly after. And we spent, 4 or 5 years really only dealing with London, maybe a few years less perhaps. But then we've had, obviously Brexit came along, there was that sort of wait and watch and sort of mindset, which we were in as well, and many of our clients were. So we've done very little in London until recent times. But it's interesting to see that the demand is picking up, that it was ranked by PwC as the top real estate city for investment, and the same by EY. So there's a lot of noise at the moment about London, and we are very much looking for opportunities in the right locations again. So why? I mean, this is a major global city. It always will be. 9 million population. The second city in the UK is only just over 1 million, which is again a reason why we like that second city, which is Birmingham, because it's not, that matchup doesn't really make a lot of sense, does it, when you compare it to other countries and their second and third and fourth cities and how big they are and what they drive, how much economic growth they drive. So the UK is at the moment, heavily focused in London. GDP is 500 billion. Unemployment is very low. Average property prices are relatively high for obvious reasons, that there isn't a lot of stock, there isn't a lot of room, and there's a lot of wealth in the city. So it really is what you'd expect. The affordability is still there in London. There are a lot of wealthy people and they earn a lot of money. It's a huge global hub for finance still, even though there was those people saying it wouldn't be, it still is. And it's a huge hub for students as well. 380,000+ students with many top universities all over the capital. All of that means that property is never going to be a bad play if you buy the right thing in the right location at the right price. It is always going to rent. In terms of the economy, we probably don't need to touch too much on this. I mean, ultimately, we have a very strong economy. We know that, very diverse, and we have a shortage of housing. So you have an interesting graph there about that. And you also have a little bit of a mention here about startups and that sector, which again, it's one of the main cities for. So the economy is there, the strength behind the earnings that people are going to be spending on buying property or renting property is there.
I think it's, partly what we're doing is talking about London again, is because I think a lot of people are taking their eye off it in the last few years, because, there's been a lot of noise about, say, Manchester and so forth. But, when you kind of look at the stats with just the power and size of London, it's a complete no-brainer in terms of, its long-term immovability like that. Any market can be affected, but in terms of its safety, like you say, well, in terms of always being rented, the vacancy rates we have across thousands of units that we manage there is practically zero, so that's why everyone keeps buying, the big money, the smart money will always keep investing in the capital, because it is so secure comparatively. So it's what we're looking at here in terms of incomes, employment. Why this is the movement of people, of course. And so, what we want to see is a low unemployment rate, and people to have money in their pocket effectively. So it's nice to see effectively the graph going down for unemployment over the years. So a high of 9.7 in 2011 going down to about 4.4 in 2019. Conversely, matching that then with the average household income, which is basically seen a 100% rise since the turn in the millennium. This is, way more wealth per household generally, and a lot less people being unemployed. So it's just a perfect marriage, basically, for a good environment for healthy property market. And then, of course, with people with cash and so forth, you want to see the supply and demand, which is essentially the backbone of every good property investment. So London, like a lot of the lead places in the UK, but particularly London, has a chronic problem. If you were standing there, if you lived in London for any amount of years, you'd be fooled for thinking that wasn't true, because you see cranes around the place all the time. But, the targets that the boroughs between them and the local mayor has put together is basically around about 52 to 55,000 homes that they hope to build. Actually, the target is 65,000. So even with the best will in the world, they're not going to hit that. But actually, the past performance in the last 10 years, the average has been just over 20,000 homes delivered per year. So, they're hitting a roughly 20% of the needed property is a compounding problem, which is going to keep putting pressure on the housing market going forward. So it's very difficult to talk about a bubble when you have such a lot of wealth in such a small place with such a limited amount of property going forward. And so generally by the end of this decade, there's an expectation for about 1 million homes deficit in total. So, without some kind of, huge level planning to build, which, they're trying to, but they just don't have the capacity to, then we are going to keep seeing, supply and demand push prices going forward. So population wise, just to compound that, we're expected to see basically 10 million people by the end of the decade, really. So 70,000 new people arriving in the city each year, and that's unsustainable when, you can only deliver 20,000 homes. So in mind with that, in terms a little bit of what we're talking about with London and what's happening culturally, and we've picked up, we're launching this project in the last week. Some of the sharp-minded of you might realise that actually Solarium is a project actually we launched off plan a year ago, and we had 32 units there, which we sold. But we're bringing a phase 2 intentionally now to bring something slightly different to market, which is a completed offering. So we have pre-furnished and pre-let this, and now are launching another 15 units on the top floors, which are ready-made investments for people. So, but the opportunity here in terms of the investment case is very much this lifestyle play. It's in the middle of one of the biggest regeneration projects in all of the city on the Great Western Corridor. About 25 billion being spent over this region across 3 boroughs there, and just across the road from the Brentford project, which itself is a 500 million redevelopment scheme, which has got both commercial and residential, and a new football stadium for the new Brentford Premiership team. But this is a value play amongst one of the wealthiest pockets of West London, right in the middle of Chiswick and Kew and Richmond. Really great access both into the centre of the city and to Heathrow, both within about 15 minutes. So, it's at London prices rather than Birmingham, Manchester, but we have, units here from 380 up to 560, but with a guaranteed yield because you have a sitting tenant in there as the property completed earlier this year. So something for people to look at.
Yeah, and I think we originally, just to sort of clarify, we took the top floor penthouses from the developer. We sold those, gosh, when was it? Just after COVID. There's a lot of communal space, there's a lot of breakout space, there's a lot of balconies. It kind of made a lot of sense at the time for that kind of building. And then we've secured some lower floor units. Jeremy, are you doing this slide or me?
Oh, both of this, yeah. I mean, look, what we have here effectively is just a general view, really. Actually, we've got list here of the major cities someone might consider investing in the country, basically ranked in terms of their population size, for giving it no other merit than that, but just to give a view of a headline idea of what's happening there. So yes, we've talked a bit about London now. So what we're seeing there is recovery and resurgence effectively from 5 years of being a bit muted. The prime central can kind of come back a bit, but particularly it's these areas of zones 3 and outwards, basically, which hold a bit of value still, which are probably going to see the biggest bump in the next few years. Birmingham being the second biggest city in the UK, it's going to be the first to get connected up with the HS2, the high-speed rail line, which is going to go from north to south, and that's going to be a huge booster when that gets delivered, probably in around 2026 to 2027. But also there's already a migration of companies and people to get to there because there's slightly cheaper rents and slightly more affordability, but that's going to be within about 45 minutes commute time to the centre of London. So it's very easy to see why a big city like that is going to rise in value and be very safe over the next few years. Glasgow, that's an interesting choice, the third biggest city, one of the biggest financial markets in the UK as well. That's a high rental market still. You can get 6% yields in prime areas there, and there's got a lot of value there. We had a project last year for 2 beds for under 200,000, and it's just very easy to see why there's going to be movement. Leeds is a market we like. We have had projects there. It's about 25% average cheaper than Manchester, and the other big player up north there. When we can find value, we're happy to go there. Certainly the developers have got their tails up a little bit and maybe pushing prices in the prime centre. But as a market overall, we see a lot of potential movement there in the next few years. Fifth biggest city, Sheffield. We did our first project there this year. We're very excited by that. Again, what we're seeing there is very affordable prices and very decent yields in a market which is undervalued for the size of town that it is, basically city that it is. So we hopefully will continue to buy there. Manchester has been enormously successful. One of the main benefactors probably of Brexit, really, in terms of the migration of where people are investing, and it is a very dynamic market and will continue to be, and we're very interested to buy there. The only caveat I would say to that is that anything within the central ring road has really pushed up in value. So it's very difficult to find new build projects there under £450 a square foot in those areas, considering we were buying at £300 a square foot within 5 years. That's a big rise in that period of time. So we're probably starting to push slightly out of the city centre for better pockets of value. So if you're interested in Manchester, just bear that in mind. Liverpool, similar kind of story, I suppose, and trajectory, I'd say, to Leeds. It lost its World Heritage status in this year, but the dynamics of it in terms of supply and demand are still there for growth, and it is a relatively cheap market. And then others, might people think about Brighton, Reading, and particularly for us actually as well, commutable areas around London, places you can get into the city within half an hour are very much of interest to us. So across the UK, there's plenty of opportunity and interest. It just means, like ever, just pick the right things for the right reason and know the price per square foot you are buying at is very comparable and favourable compared to other things in its local vicinity is the major thing.
Thank you, Jeremy. So it gives you a very brief sort of overview of the sort of areas that we look at and see value in. So we were going to have a little look at Birmingham being the second city. I mean, I think Birmingham is on people's minds at the moment because there was the news from government in the last few weeks about the high-speed 2 rail line being sort of cut back a little bit and the extension to Leeds not happening. So really at the moment, the only part of the line that is guaranteed is London to Birmingham phase 1. This is this new super fast train line running from London to Birmingham, and it's going to reduce the commute from what is about 1 hour 25 down to 45 minutes. So Birmingham really is going to see a lot more investment because of this news, is our view. It's always been one of our favoured markets, and we're delighted that we've kind of got in because it took us a long time to find some opportunities and get into the city. In terms of, just going back a slide, please, Nicola. In terms of what we see, I mean, those graphs look very similar to London's. You've got a rising income, household income there on the right-hand side. And you've got a dropping unemployment rate, obviously, albeit they're slightly larger figures, but they're trending in the same sort of direction. We know at IP, the research is key, and these are the sort of graphs we look at before picking a market to go into. And then we obviously see the population growth. And ultimately, I've probably referenced this already, but property goes up in value for a couple of reasons, in my opinion. And the main thing is that you've got more people, and those people are earning more money. Now, whether that's driven by regeneration or just this, like Dubai being a huge city that has this huge growth in population, it makes sense because people are going to be earning more money. Then you've got to look at how sustainable that is. But ultimately, that is what's going to drive growth. Next slide, please. There's so much regeneration going on. I mean, if you went to Birmingham 15 years ago, you probably thought, it's a bit quirky. I'm not sure I want to live there if you were a Londoner, but you now have the lifestyle to go with it. So, companies now aren't getting that resistance when they look to move here. The staff will follow them because they've literally transformed the city centre. They've built a super brand new station in the middle called New Street Station. They've regenerated the whole of the sort of central Birmingham that sits around that. There's a little area called Brindley Place, which is lots of nice bars, cafes and restaurants. So it's got that kind of lifestyle now in the centre. And finally, the road system's been fixed, so you can actually kind of get around a bit better now. There's a tram system. There's a new train line coming in, which is top right-hand side, which is the Curzon Street station. So that station is a new station for the high-speed 2 terminal. So that's on the eastern side of the city, the kind of value side. It's going in there for a reason. And you've got all sorts of stuff. Smithfield's a big commercial, residential, 500 million redevelopment. There's so many things going on. We've really touched on this already. When we've got undersupply, we've got affordability. The bottom left-hand graph shows you the affordability ratios. London being at 12, Birmingham being almost half. So that's really just looking at how much people are earning in comparison to what they've got to pay to buy a property. So you've got room for movement there. And it's below the average still. So it's the second city, but it still sits below London, England's affordability at 7.6 times salary. So very interesting statistics, very interesting market, and certainly somewhere that we are very keen to encourage people to explore. We already manage, a good few hundred units in the city across our projects. They rent all day long, every day. Very easy for us to manage those, very easy for our clients to collect those rentals month on month. Similar to London, but not as absolutely watertight as London, I think, obviously. And Jeremy's going to lead off about silversmiths.
Okay, fine. Well, this is one of our latest projects in Birmingham, and from that map, actually, where this is kind of the north west side of the city. Birmingham is kind of split into two in that regard, as in to the southeast, there's Digbeth is an area we've also been interested in, which is kind of much more of a regeneration area of factories and so forth. To the northwest, the jewellery quarter. This is essentially it's the kind of more posher, if that's the word you want to say, kind of residential neighbourhood, very established. It's been doing quite well actually for the last 7 or 8 years there. But what it is Victorian red brick properties. So streets and streets of these, so highly desirable for local tenants to live in there. And there's actually 200 grade 2 listed buildings in the city, and this is one of them. So its history is that it was an old jewelry factory, being the jewelry quarter. There's still 40% of the country's jewelry is built, made in this area still. But a lot of it can get converted into very attractive residential buildings. And so you can see from the kind of, very high ceilings, big, very, the windows, very floor to ceiling and so forth. But, it's that kind of character, which is absolute gold dust for renters. These things will rent, within a week or two, and it'd be one of the most secure income streams you can have in the city. And because it's so popular, we see it rising in value pretty strongly over the next 5 to 10 years or so. But it means you can get in from around about 235,000, or 2 beds probably starting around the kind of 340, 350,000, but just one of the strongest yields you could find in the UK's second city.
All right. Thank you very much, Jeremy and Will, and thank you everyone for joining us. We are ready to open it up with the Q&A session. We have a couple of questions already. If you have a question, please, now is your time to submit it. Shall we start with the question for Jeremy? If you had to choose between Leeds, Manchester, and London for 2022, where would you choose?
Look, it's an interesting question. It's good in that regard, but essentially you're talking about kind of the sliding scale of prices and therefore risk, I suppose, isn't it? So it's the biggest, capital in the country. Like, I think the simple answer to that is that it's very project specific. There are very good areas in all 3 cities there, but it depends on what your individual circumstances are, where you are in your portfolio, and actually seriously what you're buying in terms of per square foot for the area. There's plenty of properties in each of those cities which are probably overvalued there. So it's just about knowing what's there. But I think all of them could easily find you 20 to 25% growth over the next 5 years if you just pick right. I don't know what you'd add to that, Will.
Yeah, I think it comes down to affordability as well, doesn't it? I think the other thing to consider is, if a client of ours has got 3 or 4 properties already in London, it's the right thing to explore other options and, perhaps look at one of our new markets. And a market we put a lot of effort into is Germany. And if somebody wanted to ask me where the best returns are over the next 10 years, Germany needs to be in that conversation. some of the rising cities in Germany, which we're heavily focused on.
Thank you very much. All right, and there's another question, a bit more micro. What areas of London would you be looking into?
I mean, I'm happy to take that question. I think it's the pockets. I think the key thing in London is you need to be taking a view about the area you're investing. If you want to make money, you need to be taking a view about where you're investing and what you think the area is going to be looking like in 5-10 years time. And we've always done that at IP. We've always been very brave, and we've been investing in areas where perhaps the others aren't, and talking to people about different opportunities and off the grid opportunities. So I think that's the key to maximizing your return in London. So think about Crossrail still, think about the east, think about the value areas in the north and the south.
Thanks, Will. And we have a question from Martin. What is the advantage of projects when yields of 8.5% are achieved in more northern cities versus cities with lower yields? Jeremy?
I mean, firstly to that, I would say that, why is it 8.5%? I'd say even in, most northern cities, if we're going kind of up to Newcastle, Sheffield and so forth, which are on average probably the cheaper cities, your relatively city centre properties are still really going to be hovering around the 6% mark. So yes, of course, it's possible to go and find an 8.5% yield, but frankly, anything that kind of tips over 7% is a slight red flag territory for me. And I'm thinking, why is that? Yield is a reflection of risk, and that probably means it's in an area which is quite cheap compared to the rental yield you can get on an annual basis. And so there must be reasons for that. Why are people not attracted to it and buying it more to make it more expensive? So how you make money from property isn't just about rental yields. You are less likely to see significant capital growth in areas which are not desirable. So a lot of factors come into play, but your security, your vacancy rates will all come into that. Just as a basic example, yes, we pick projects which are always in the most demand areas of each given city, but London, we basically run at a 99.8% occupancy rate, whereas in the kind of northern cities actually across our portfolio, it's more like 96%, which is obviously still very good, but it just goes to show there's a difference there. And so you are more likely to have security in the bigger markets where there's more money and more people drive property, essentially.
Yeah, I think that's well answered, Jeremy. I think the other thing to be aware of is just being misled. We've run a series of webinars where we're sort of talking about the crucial truths, and we're accountable. We manage and we rent the apartments that we sell. We can't blame anyone else when they don't rent for what we said they're going to rent for. So ultimately, we actually did a stat on that. Like last year, we had a review of our expectations, because when you'll buy with us, we can show you kind of cash flows and so forth, which will show what the projected rents will be across the portfolio. The achieved rents actually, I think the stats were around about 400 units. We were 105% achieved rents compared to what we originally said on our cash flows. So it goes to show that we have to be realistic, not salesy in terms of our projections there. Yeah, and you aren't going to get an 8.5% yield on a property that's ever going to go up in value. In Sheffield, ultimately, that doesn't exist. So I would suggest you're being lied to.
All right, thank you very much, Will.
Good question.
Yeah, we do have another good question here. Is now a good time to consider investing given the furlough scheme and the end of the stamp duty holiday?
It's the stamp duty holiday boosted the economy, it boosted the market for sure. It bunched up transactions. Perhaps you had 2 years worth of transactions pushed into 1 year. Perhaps you had transactions that wouldn't have happened for even longer pushed into 1 year. But ultimately now we sit in a position where there's a lack of supply. We have, could look now, 8 apartments left on our books, and we're committed, we have to buy what we put on our books. So we're always looking at that thinking, we've got to be a bit careful. But at the moment, we're the other side of where we want to be. We haven't got enough by a long way. And that's a reflection that there aren't that many opportunities coming to market at the moment. And that's the same in the sort of general market, right? In terms of the sort of housing market, the bread and butter of the market. But in terms of what we do, developers have been slow launching schemes, planning permissions have been stuck in neutral for 2 years. This is what's going to hold value and drive value moving forward. So yeah, I think my view is that my answer to that question. Jeremy, anything to add?
Yeah, like I just think exactly. You know, the economy was actually on such a kind of a good driver in terms of the unemployment and so forth, considering it has been the lowest it's been just pre-COVID, and the fact that actually it's projected to get there at the back end. When you're marrying that window, a window of opportunity with the lowest interest rates we're likely to see in, you know, next couple of decades, that's the window of opportunity. So it's not just about where headline prices are at the moment, it's all the other factors which come into play in terms of the cost of your investment and so forth. So if you can fix a 5-year rate at the moment for 2.5% with a bank, which is possible out there, not all banks do that, but that's something you'd bite your hand off basically to be able to take advantage of.
Yeah, that's a good point, Jeremy. You know, the liquidity's there, the banks are supporting the market, people are borrowing, and people got money. You know, ultimately people haven't spent as much money as they expected to in the last couple of years for obvious reasons. So yeah, we're very confident. Actually, we've had a real strong bounce back. We've had a very busy year, and we've run out of stock because we've sold more than we expected we would, to be honest with you.
All right, thanks very much. We only have enough time for one more question. So let's go ahead with the most recent one. How do you choose between a house or an apartment? Which has more investment potential at the moment in the UK?
It's a good question, that. I think it's just about, I mean, what I consider buying that, it's about the area. Some places houses are going to be perfectly good. Clearly in cities, you know, there'll be more apartments there. And what I think about the liquidity of it, I think about the exit, and it's much easier to sell a 1 or a 2 bed in an area of undersupply in the end than it is potentially to sell, you know, a 4-bed house. You know, there's a smaller group of people who will be buying that kind of property basically. So in terms of speed of sale and potential uplift there, that's potentially what it is. But you know, it's also what your needs are in your life. You know, this is pure investment. You know, it's going to be quicker for you to rent an apartment than it is a larger house. You know, it's specific to area certainly.
Yeah, and I think from my point of view, I mean, we're very focused on apartments. As an international investor, you know, having a garden fence and having a garden and having a roof and having rising damp and having a cellar and having floorboards that lift and things, you know, none of this, and all heating systems and plumbing systems and you know, none of this really is an issue for us when we're dealing with investments, because we're buying quality new builds that ultimately 10, 12 years down the line, we don't need to do much on this. I mean, since I own my apartment I bought from IP in Manchester, I think I fixed the lock, the door, the seal on the bathroom and the toilet seat or something like that, you know. But if that was a house, I can almost guarantee I would have had to spend more money maintaining it. Now, of course, I spent money maintaining it, paying a service charge, but ultimately that's just taken care of for me simply and easily. So it's just also a sort of practicality thing as well for us as a company, because we manage these apartments.
I think it's a good thing, because you know I would often get asked by people that, you know, well, actually, is it sometimes better to have a freehold versus a leasehold in that regards? But that does mean if you buy the house, you're likely to have the freehold in it, but it means liability. You know, if anything goes wrong with it, the big what if something went seriously wrong with the property there, like say rising damp or something, that can be a big payout. But actually with a leasehold, which, you know, most of our apartments will be 250 years or so, effectively it's that kind of insurance bracket. You know, if something goes wrong with the property, you've got warranty on it for the first 10 years, and then you have, you know, part of that insurance has got into, you know, a sinking fund, and you've got it covered. You know, the property is kind of between you and all the other different landlords in the building.
All right. right, thank you very much. Thank you everybody for joining us. We hope you found the webinar informative. If you still have a few questions, we will get back to you with a wealth manager in your region. Otherwise, you can submit them to inquiry@ipgloballtd.com and we will get back to you shortly. If you only joined the webinar halfway through, we will have the recording available for you in a few days' time, so don't fret about that. All right, well, thank you very much, everyone, for joining.
Yeah, thank you very much.
Thanks a lot, everyone. Thanks.
All right, bye, everyone.